Okay, hello and welcome to this module 10 of the price ladder course. For those of you that made it this far along this journey to the peak of becoming your price ladder or price action trader, very well done and congratulations to you guys. This is your last sort of milestone along the way. And what we're going to be looking at in this module, it is a pretty chunky module, and there's going to be quite a lot of theory to actually cover before we can even look at the price action. Obviously, you guys have covered um, all the foundations of the price action that at least you need to get to this stage, and this is a lot more theoretical based, so when it actually comes to executing, you have no second thoughts about what you're seeing on the price ladder, and hopefully when you're doing doing some of those drills, you can actually start honing in on some of these skills. So what we're looking at specifically in this opening introduction to module 10 is understanding central banks, and specifically how central banks create market opportunities. Now, obviously, for those of you that do trade in the market, for those of you that are active and do watch central banks, you're very well aware of the fact that central banks move the market, and they're very much an influential part of the marketplace. But we just want to cover more or less just the basics. So what is a central bank? If we had to really start from the basics, the central bank. So if we had our central bank in here, so the central bank, the primary objective or the primary goal or purpose of a nation or a state's central bank is to basically control the money supply. So that's what they're there for, control money supply. And in doing so, obviously, basically, you say they want to control the monetary policy of that state or region. So we know that they want to control the monetary policy. What are the goals? Now, obviously, the main thing you want to be looking at is what exactly are the goals of each central bank, because the goals can differ from central bank to central bank, from the ECB to the Fed to the BOJ, the Swiss National Bank, whatever it may be. They have certain goals, but if you had to look on a wide spectrum, we're not going to go into specifics just yet, but the goals, the main goals of a central bank are to basically maintain price stability. They also want to have maximum employment. And third, they want economic growth. So we know basically that central banks look at these three pillars. These are the three pillars that they look at. And obviously over time and through economic cycles, they might be targeting different parts or different segments. It does depend on their mandate. For example, the ECB, their main mandate is price stability. So they'll be looking specifically at inflation. How is inflation in the economy? Or in other words, how is the market pricing in inflation expectations as well? So in the current market environment, what's really pertinent and really important is, is there a risk of deflation? Is there a risk of the market getting into a deflationary spiral where they'd rather make an investment tomorrow because they feel as if prices are moving lower? Inflation obviously is as you increase the money supply in the system, what you're getting is prices of products actually increase. The value of that legal tender or that currency actually decreases the more you increase the money supply. So what happens is, at least over time, you get a steady amount of inflation. What the current monetary regime now in the world states is that you should have a healthy rate of inflation around 2%. That's what nowadays, at least, they're targeting is around 2%. That might actually become outdated in a few years. We don't know. Maybe 2% is too high. But in any case, that's what they're currently more or less targeting. And sometimes they try and target the employment aspect. So the Fed for many years, right after the financial crisis in '08, they were targeting employment. Now they're not targeting employment as much, as we've come to a point where we've reached that maximum, almost that maximum employment area of about 5% unemployment rate. So really, there's different economic cycles, and the central banks act accordingly during those economic cycles. But obviously, the evolution of the central banks has changed over the years, and that's something that's really quite important to understand, is the evolution. I'm not going to go through the whole timeline of events of how the role of central banks has actually evolved over the years, but I would encourage you guys in the slides on the Prezi to actually look through just the main milestones since since the fall of the gold standard. When we had Bretton Woods, this was a good 40 years ago now, more than 40 years, around 1971 was the Bretton Woods Agreement. So since the fall of the gold standard, we've had this unprecedented rise in global credit. So, I mean, if we just had to sum this up, we've had the fall of gold standard. This in turn led to unprecedented credit. And with that, we've had bigger booms and busts, because the market had a lot more credit to trade with, to invest in. And what we were seeing was an increase in debt, an increase in leverage, and then we would go through leveraging cycles and deleveraging cycles. So, if you were to look at the market, and not the market, but at least productivity in a market, it was something like this, and you'd have your economic boom and busts, where you'd have these large moves up in leveraging, and then quick deleveraging, and then leveraging up, and then quick deleveraging. So you'd have these really big cycles. And that's kind of amplified, because if you look in the past, we did also have these boom and busts, but they were more subtle. So now we've kind of amplified or increased the level of leveraging and deleveraging in the market. So that's really quite important to understand how that's changed, and how now the role of central banks of coming in and actually coming into the market and assisting or acting when we're getting these really violent deleveragings. You have central banks acting in these violent deleveraging cycles. So that's really kind of how that's kind of evolved over the years. And what we've also seen, so after we've seen this, obviously, like we said, we've seen bigger booms and busts, and then obviously we've had, with those bigger booms and busts, we saw the first big bust in 1987 on Black Monday. And then moving on to that, we had more busts like the dot-com bubble. Obviously, there was a few in between as well, 1997, 98, with the Asian crisis as well. But overall, there's always bigger and bigger busts in the game. And now we came to a level where we were actually doing huge, like a massive financial crisis ensued in 2008. So we had the 2008 financial crisis, which then that kind of evolved into the 2011 sovereign debt crisis. And along the way, as we saw along the way, the central banks were basically intervening. After the dot-com bubble, we had very low interest rates, and we saw after the financial crisis, we started seeing the likes of QE. We started seeing the likes of LTROs and OMTs from the ECB. So it's low interest rates. So basically, the central bank are intervening into these massive booms and busts. So every time we get these huge moves in the stock market, the credit markets are bursting. People are spending money, lending money. The economy's thriving, and then you have these massive downturns, and then the central banks basically stepping in. And propping up the market. They want price stability, they want economic stability, and they're promoting general stability in that economy via doing that. So overall, the role of central banks has become a lot more pertinent in the market, and what you're seeing is actually the market paying attention more to what central banks are doing rather than the actual economic data. They are paying attention to the data, but they're more looking at the data to see how the central banks are going to react to the data rather than actually taking the data into consideration, saying, well, considering that we have such high unemployment, considering that we have such dire inflation, maybe we should have a massive downturn in the market. Well, no, because the central bank might step in and buy. So, bad data is starting to actually invoke, you know, big price swings to the upside just because the market is kind of pricing in a central bank stepping in and taking action. So you have to really understand how the mentality of the market has changed over the last 30, 40, 50 years. It's nothing like it used to be, and I'm sure this is unprecedented territory, and this may change in the future as well. So something like the likes of QE might actually become a conventional policy. We've seen before a conventional policy was lowering or increasing the interest rates, but now we've had low interest rates for a good 7 years now in the markets. And all we've been doing is either QE on or QE off. That could be the new conventional policy, as opposed to raising or decreasing the interest rates. We might just have low interest rates indefinitely, and when we need to ease, we just either put on QE or decrease QE. So basically, understanding this dynamic is really quite important, and I can't go through this in very much detail. I'm very much only scratching the very, very crust of the surface on this whole economic machine, but I would definitely recommend you just do a little bit more research and understand the role of central banks in general and how it affects the market pricing. From our perspective, what we need to understand is, and the only thing that I'm going to mention with regards to opportunities, well, you have to understand central bank trading opportunities. These central bank trading opportunities arise from mispricings, or at least understanding that it comes from understanding market pricing. So you have to first understand market pricing. So if you understand the market pricing, and I'll tell you what I mean. If you understand the market pricing, you can understand where the market's positioned. Because if you can understand where the market's positioned, and if new information comes into the marketplace, then the market needs to shift value and trade in a different area that it was trading before. And the central banks, because they're so powerful and they move the markets so quickly, if you can understand what's priced in before a central bank, coming into a central bank meeting or a press conference or any sort of risk event when a central bank speaker is out in the market, if they say something that needs that basically forces the market to change its perception on risks or generally where the market's priced, the market will move, and it will move very aggressively, and that's where you get these opportunities arising. And we'll talk about this obviously in a lot more detail when we move down the line in this module. But just understand the concept that trading opportunities, when it comes to central banks or any sort of risk event, is all down to understanding market pricing. If you can understand what the market's pricing, you have the biggest edge over any market participant that doesn't understand market pricing, because you can understand how the market's positioned. And we'll talk about this in a little bit more detail later on. But in the next module, what we're going to cover is actually the process, and this is probably the the crux of this module. What you really need to understand in depth is how to prepare for central bank trading opportunities, and it is a process, is a very thought out process, something that we've done and put together over many years of trading these events at Futex, and hopefully we'll get to that fairly quickly so that we can actually move into looking into some actual practical trading examples. Thanks very much for listening and stay tuned.